Hi there, good evening. My name is Isaac Thong, and I am the lead manager of Aberdeen Asian Income Trust. I hope everybody had a good summer break and are back to life and well and ready to end off the rest of the year. So just very curious, just a show of hands, how many of you have actually been down to Asia over the last couple of months? Just show of hands. Okay, quite a few. If you have been a frequent traveler to Asia, I think the one thing that you'll realize is that change is one of the only constants in Asia. Things are changing all the time, growth is all around you, and the growth opportunity in Asia is large. People in Asia embrace this growth opportunity with a sense of optimism, and we at Aberdeen in the Asia team really approach investments in Asia with a similar spirit. We approach markets in a cautiously with cautious optimism, and we also really embrace this opportunity. So what the trust essentially gives you is that exposure to Asia's growth story and to progress in Asia, right? So more about the trust, which is what we all came here today for. I think the first thing you'll get with our trust is you'll get a great long-term track record. We've achieved close to 4% excess returns over and above the benchmark for the last 5 years. That's point one. The second thing you get with our income trust is a very attractive and healthy dividend yield of around 7%. And this is a very sustainable level of dividend yield we are very comfortable with. And why do I say that? Well, the board of directors for our trust has just this year instituted a new enhanced dividend commitment of 6.25% of NAV on an annual basis paid out to you quarterly. And last but not least, the trust trades at about a 9% discount to NAV right now. This is quite in line with what we're seeing in other trusts in the market. But if you compare us to a subset of close peers, you'll notice that we are trading at more than 2 times the discount of some of our closest peers. And rest assured, the board of directors are, if I can say, laser focused on that discount and will manage that discount in the best way that they can. So with all that said, I think what I'd like to impart to you today is really 4 key takeaways. The first is why Asia. Second, why income. Third, why Aberdeen, of course. And last but not least, why now? Why is now a good time to invest in Asia? So let's start with the first point. And after we've digested all the 4 points, we can talk a little bit about performance and how we're positioned for the future. But let's just go with why Asia. So if you look at what Asia has done historically and on a forward-looking basis, Asia has and will continue to drive over half of global GDP growth. That's a very powerful thing. But I think one thing that's not mentioned enough excuse me, is that the strong economic growth potential in Asia has led to very good total shareholder returns over the last 20 years, right? So strong economic growth has trickled down into strong corporate earnings growth, and that has, in essence, driven total shareholder returns over the last 20 years, right? And this is not always the case in global markets. So this is very unique to parts of the world, including Asia. And I think one thing that is also, one thing that kind of throws a wrench into this story is that over the last 5 to 7 years, the rise of US exceptionalism, the rise of the Magnificent Seven companies have really taken the spotlight away from this story, right? But I think what we want our message today is that story has always been the case. It has been the case for the last 20 years. And I think given the state of the world today, given the state of global affairs, there is a case for that spotlight to shift back to Asia's growth story. When you compare Asia to the rest of the world, you'll see 2 unique features. Asian markets really offers you a very unique combination of dynamic growth and dependable income. So what do I mean by that? Dependable growth is something you get by investing in the emerging Asian economies, such as India, China, Indonesia, Thailand. You get dependable growth on the other side by investing in the more developed Asian economies, right, such as Australia, Singapore, Hong Kong. And that unique blend is very, unique to this region. I know some of you here today are looking at emerging market investments. You look at things from an emerging market perspective, but if you look at emerging markets as a whole, outside of Asia, that tends to be pure growth markets, right? They are high growth markets with a lot of inflation. And you really get that unique combination only in the Asia-Pacific region. So that's really why Asia. That's our proposition. So I think more importantly, why income? Why use an income strategy to harness Asia's growth potential? Well, that's because Asia's growth comes along with a wider range of outcomes, right? Growth is, there's some uncertainty in Asia in terms of politics, in terms of geopolitics, in terms of how old companies are. So if you look at some of these internet giants in China, they're just about 20 years old. They're just got out their teenage years. So there is a lack of corporate maturity in parts of Asia, and we propose that a good way to keep this in check, keep these 20-year-old companies in check, is having a very strong dividend policy. So like every teenager out there, there has to be guardrails in place. We also like to think about it as driving a car. So imagine you're driving a car, you're trying to go back home, and you're driving down the highway. But unlike the highways in the UK, that are very straight and get from point A to point B very easily, this highway is a winding highway. And the second problem is your car only has 2 speeds, right? Stop and then go fast. Because it's a car from Asia, it only knows how to go fast. It's one of these new BYDs you see on the road. So that's the challenge of investing in Asia. And what we really want to do for you is to get you home in one piece as quickly as possible. So that car better come with a good set of brakes, better come with a good working airbag, and also have good GPS navigation system. And that's what we're trying to do for you with the income trust. We're using a quality income approach to harness the growth in Asia in a very accessible way. And you know what? The market agrees with us. So this is a decomposition of returns in the Asian market since the year 2000, right? And you'll see that dividends have driven half of total shareholder returns in Asia. And we think this is likely to be the case going forward. What the market doesn't tell you is why this is, right? We think that the market agrees that growth comes along with a wider range of outcomes in Asia, and they demand certainty today. They demand an income today. And you get some growth in the future, you get some capital returns in the future, but they demand income today. And just think of the 3 classic ways that companies destroy shareholder value. And this is not just in Asia, this is globally, right? The first way a company can destroy your capital is by doing a lot of mergers and acquisitions. There's studies done that 75% of global M&A tend to fail, right? And then the second way that companies tend to destroy value is empire building. Let's grow for the sake of growth. Let's conquer this market. Let's not really care about shareholder returns. This tends to end in tears. And the third way companies tend to destroy value is cash hoarding. So companies that accumulate cash on their balance sheet, let's save for that rainy day. But you know what? That rainy day just doesn't come. And at the end of the day, you're left with a very lazy cash balance sheet, affecting your returns on equity. And what we propose to do is by having, when a company has strong dividend policies, what we're essentially doing is we are incorporating corporate governance into a business, right? So imagine you're a CEO of a company, and I take away half your capital from you every single year, right? You're going to think 2 times, 3 times before you make those 3 classic errors, right? You're gonna have a long think before you work on that new M&A, and that essentially is what we're trying to do as a strategy for the trust. So in essence, what we really want to do here is to invest predominantly in what we call high quality dividend franchises. So what is a dividend franchise? Well, we have 3 guiding principles to identifying high quality dividend franchises. The first is we want to invest in high-quality businesses, right? And what's a high-quality business? Well, many things go into that. Strong business, strong competitive moats, good management, good balance sheets. But for us, the net outcome, the quantifiable outcome of a strong business is high and sustainable returns on equity. So a good business should be able to generate high ROEs over and above their cost of equities over long periods of time. That's our first criteria. Our second criteria is a company should also deliver very reliable free cash flows. This is quite typical of a good quality business because high ROE companies tend to throw out lots of cash. And last but not least, we follow these reliable free cash flows to strong dividend policy. So theoretically, a company can pay out 100% of free cash flow because it's after investments already. But they won't because they want to pay down debt, because they want to grow the business. And maybe they want to set aside some money for a rainy day. But we really want the foundation to be high-quality businesses, which translate into strong free cash flow generation, and that translates, again, into strong dividend policy. And the three factors really feed on each other, and the net outcome of that is a high-quality dividend franchise, which we want to invest your money in for the long term. And that's a very simplistic way of saying, okay, this is how we do things. But in practice, from a bottom-up stock selection basis, it's quite complicated because there's no perfect company, not even in the US. It's a tough thing to do, but it's a challenge that we're willing to undertake for you. So now, after finding these high-quality dividend franchises, what we would like to do is to invest across a range of dividend yields. What do I mean by this? We think about things on a total shareholder returns basis. So total shareholders returns loosely equate into dividend yield plus the earnings growth you get and the change in valuations, right? And we want to optimize for total returns. And we think that total returns can be found across the spectrum of the different ranges of stocks. And we really want to support and back high-quality businesses at different stages of their corporate life cycles. So let me just give you two examples of these. The first is Tencent. So Tencent is an internet company in China. It is very fast-growing. It's basically the WhatsApp plus Facebook in China. It's very hard to make payments in China without the WeChat, Weixin app. And we think that Tencent can grow its earnings at about 11 to 12% every year for the next 5 years. Okay? It's a high-growth company. But its dividend yield is just about 1%. Right? So when we invest in lower dividend yielding companies, what we require is a higher rate of growth over the long run. So on the flip side, we have also a quality business, which is DBS Bank. So DBS Bank to us is the highest quality bank in Singapore. But because it's based in Singapore, which is a relatively developed market, it's going to compound earnings at about 3 to 4% per year for the next 5 years. But the dividend yield that DBS has is north of 6%. So once again, when we have a higher dividend yielding company, our bar for earnings growth would be lower, right? So you could really, on a total returns basis, you could hold both these quality franchises for the trust at the same time in the same portfolio, and the net outcome of that would be, in our view, quite similar over the next 5 years, right? And that's how we sort of balance the opportunity set in Asia for the trust. So what's the outcome of this? If you look at the trust from 30,000 feet, or is it 40,000 feet, you'll see two things. We have two styles, two very distinct styles. The first style is we are high quality, and the second style is we are high income. So high quality is measured to us by ROE, returns on equity. And you'll see that black bar, which is the trust, is superior to that of the benchmark. And when it comes to dividend yield, which is the income portion, we're also ahead of the benchmark. And you can expect these two styles to remain consistent over the indefinite future. So I'll skip these two slides. Next, why Aberdeen? Right? Why is Aberdeen the manager of choice when it comes to these type of funds? Well, first and foremost, quality is the North Star at Aberdeen. It guides every single thing we do, from stock picking to how we run portfolios, right? And Aberdeen, our trust is managed by 2 portfolio managers who are dedicated to this strategy. We have, well, that's myself and Eric Chan, we're both based in Singapore. We have 26 years of experience between the both of us, and we're really focused on this strategy. In addition to that, we are supported by 40 other investment professionals, and these investment professionals are all based on the ground in Asia. And if you look at that chart, we are all predominantly based, a vast majority of us are based in Singapore, and I cannot emphasize the importance of this. Having portfolio managers and analysts sit in the same location, meeting the same companies together in the same room, and coming out of those meetings discussing the takeaways is just something that is underappreciated. And there's tremendous amounts of synergies from that type of interaction. Another thing we hold in very high regard is understanding companies that we invest in and interacting with management that lead these companies. So to that extent, we meet over 1,000, we hold over 1,000 company meetings every single year. It was closer to 1,500 last year. And this really guides us and gives us conviction in terms of the stocks we own for the trust. We also vote proxies very frequently. So we want to give you a voice at each company's AGMs. So why now? Why is now a good time for Asia? Well, I think to summarize, Asia is currently undervalued and underestimated. Just as simple as that. If you look at traditional valuation metrics like the PE ratio, you'll see that Asia in the black line, compared to developed markets, which is the orange line, you see that we're trading at the widest discount, the relative discount to developed markets over history. We're cheap. And then if you look at metrics like returns on equity, which is how we look at quality, you'll see that Asia, once again, the black line, is just emerging from that COVID trough. We are getting back to where we started, and we are poised to go even higher than that, right? While if you look at global indices, especially that of the US, they're marking new highs every day. So you could say that, okay, with the rise of these really strong companies in the US, with very new business models, very successful companies, you could say that they are increasingly priced into the market. And for them to beat expectations, that bar is getting higher every single day, right? So Asia is quite well poised vis-a-vis developed markets. The second point I'd like to make today is we're seeing, on the ground, we are seeing policy tailwinds start to build. I'm sure everybody is familiar with the tough situation that China has been going through. It's been going through, it has had very tight policy for the last 4 years, and it's gradually unwinding that policy. So we all started off with common prosperity, which was a slogan in China. And today, if you go to China, you'll see that common prosperity is not really mentioned anymore, right? They've unwound that. And in fact, today, the government is focusing on this new policy called anti-involution, which is a policy to restrict or control the supply side and to really stoke, reignite the inflationary impulse in China. And in Korea, we're also seeing policy tailwinds. They call it the corporate value up, but what it is essentially is a corporate governance rejuvenation in South Korea, quite like what we've been seeing in Japan, right? So Korea has always traded at a discount to global peers. And what the government is really trying to do is to improve corporate governance, improve dividend payout and capital returns. And it started in earnest last year. And this year, after the new president was sworn in, I think it's accelerating. And we're quite positive on that development as well. So those are just 2 things we want to highlight in terms of policy tailwinds. I think last but not least, I'd like to highlight the importance of tech, in particular Taiwan and South Korean technology companies in Asia. These are essential companies. They provide the picks and shovels for which AI infrastructure is built upon. I would even go further to say that AI in its current form, the ChatGPTs you use, it just wouldn't exist without the Asian supply chain companies. Every chip that's made by NVIDIA or AMD has to pass through the Asian tech supply chain to become physical reality. And if you look at the chart on your right, you'll notice that, once again, Asian tech companies are trading at a very wide discount to global peers. Right? So it too is cheap and underappreciated. So that's the 4 points that I wanted to share with you today. If you've forgotten everything already, just remember this. Asia comes with a lot of growth. That strong growth has translated to really strong total shareholder returns over time. Income is a good strategy to tap Asia's growth potential because Asia's growth comes with a wider range of outcomes. Aberdeen is a good manager of choice because quality is our North Star, and it's a really natural place to run this quality income-focused investment trust out of. And last but not least, Asia is undervalued and underappreciated, and now is a good time as any. Right, so with that, let's go into performance and positioning. So performance has been, on a year-to-date basis, the trust is a little bit behind the benchmark. But over the last 3 months, we have made good strides, so we're catching up. But if you look at things from a longer-term perspective, over 5 years, we are comfortably ahead of the benchmark. And given our very consistent quality income approach to investing, we are optimistic that we can extend this good set of performance numbers. When you look at how our portfolio is positioned, we tend to take a 3 to 4 year view when it comes to investing in stocks. So when it comes to the countries we're invested in, I think one thing you should note is that those active positions where we're overweight and underweight are relatively benign, right? We have enhanced the strategy further to pull in those active weights because we know what we're good at. We're good at picking good quality companies. We're good at picking stocks from the bottom up. And we want to express that view on a stock level rather than on a country level. So what we are bad at and what we're terrible at is calling policy, calling macroeconomic direction, calling geopolitics. We're just terrible at that. So we don't want to express that view on a country basis, right? So we've expressed a very narrow range of country actives. Perhaps it's not easy to see on that chart because everything is scaled, but we've really brought in that range of country actives. And if you look at our top 10 holdings, I think one thing that you should take away from that is they are incredibly diverse, right? DBS Group is our top active right now. It's a bank in Singapore. Samsung Electronics is a memory chip maker in South Korea. HDFC Bank is a leading retail bank in India. Acton is a semiconductor company that's focused on networking. So they help chips talk to each other at an increasing pace and really facilitates AI servers. And I can go on. They're just very diverse from different sectors in different countries. I think the key message here is that Asian markets are deep and broad, and we find plenty of quality income opportunities in the market, and there's a whole diverse breadth of choice. And last but not least, we are active managers. We want to stay active in the market, so we have historically used market volatility to reposition the trust, right? And I think recently, year to date, that number has been quite high because the markets have been volatile, but also because I have just joined as a new manager on the trust. I've just celebrated my 3rd month anniversary at Aberdeen, but don't worry, I've been doing this for the last 16 years, so we're okay. But as we enhance the portfolio and pull those the country weights in, as I spoke about, and really focus on the bottom up, we do expect that that turnover, the level of turnover, will come down. It will come down to a more healthy range because a lot of the heavy lifting has been done, and the trust today is very well set up for the next 3-4 years. So thank you for your attention. With that, I conclude my presentation and happy to take questions. Thank you.
Question first round here, please. Oh, no, first at the back, and we'll come in 2 seconds. Thank you. Yes, please.
Yes, hello. Thank you, Isaac, for a very positive presentation. But looking forward to the next few years, I wondered what impact you think President Trump's big tariffs might have on the level of Asian growth, and in particular on the companies you hold in the fund.
Yeah, it's a very topical question, and the short answer to that is, what I tried to explain just now, which is we don't take a strong view on a portfolio basis in terms of where policy is going to go, and tariffs are one of them. So we do not want to say that, hey, India is not going to be affected, so we invest in it, or China is going to get away scot-free, and so we invest a lot. We don't do that for the trust. We want to focus on things at the company level, right? But to your question, tariffs are ever changing. It might change tomorrow again, but today I think it has settled in a range for Asian markets. It has settled in a range of 15 to 20% tariff rate, right? Obviously subject to renegotiation. India is currently getting tariff at 50%, subject to renegotiation. But I think by and large, negotiations have settled down, and we are in the 15 to 20% range. And within that range, I think the question is who bears the cost? Someone has to foot the bill. It's 15, 20% more, right? So it's either the companies in Asia, or the companies in the US, or the consumer in the US. And we think that it will probably be a mix of all three, right? But if you look at supply chains in general, look at China, for example, right? For China, tariffs are not a new thing. It sounds like a new thing, but it's actually not a new thing for China. Remember, Trump had a first term in 2017, and he tariffed China, right? So this is China's second round of negotiating tariffs, and they've so far been quite adept at it, right? And also another thing to note is that tariff doesn't necessarily mean underperformance or lack of performance. So if you rewind the clock back to 2017 and 18, in the following 4 years, which was Trump's first term, China outperformed the S&P 500, right? Mexico as well outperformed the S&P 500 for the first year, and then they had a change in president, and then they went into a little bit of a tough patch. But so things are not always, the conventional wisdom is not always the case. So we really want to focus on companies and how they navigate this. I think a lot of companies we hold today are either domestic facing, which means they derive a lot of revenues from their home country, or they have factories or production facilities in the US. So for some of our Taiwanese tech companies, they actually have a strong presence in the US already, and that would help smoothen things over.
Isaac, we've got a few more questions and not very much time left.
Yep.
So first of all, I think it was this lady here. Yes, please, yeah.
It's pretty much the same sort of question that I was going to ask, so try not to overlap things. So concerning the risk of tariff impacting the profitability of companies that you are looking to invest, what are the risk mitigation? Do you actually sort of select sectors very cleverly? I mean, you mentioned about domestically focused. That will obviously it's a safe option. But what kind of factors that you consider? Yeah,
that's a really good question, and we're actively selecting companies that we choose to invest in for the trust, right? So perhaps I give you one or two examples. So the largest holding in the trust is a company called TSMC. Well, it's not the largest active holding, but it's about 11% of the trust today, right? But it's 10% in the benchmark, so the active position is just 1%. So TSMC is the global leader in the foundry business. So it takes chip design and turns it into physical reality, right? And they're in the leading edge. So in TSMC space, only 3 foundries can do what it's doing, right? Which is TSMC, Intel, and Samsung, right? And as you know, Intel just had a change in CEO. In fact, Trump called the new CEO into the White House. I wouldn't go further. So they're all facing problems, except for TSMC. So TSMC really dominates the leading edge of chip manufacturing. And it's essential. Without TSMC, your iPhone 18 will go back to iPhone 10. So it's absolutely essential. There's a lot of pricing power. So that's the first thing we look for. And secondly, TSMC, if you look at where its production facilities are based, its incremental facilities will be based in the US, in Germany, and in Japan, right? So from a Taiwanese company, they're very quickly becoming a global company of the future. So that's one of the ways we do it at a company level. And every company is unique.
Isaac, we've got very, very quick now, please. A gentleman here, and then we'll have you, and that'll be us.
Yeah, thank you very much. You may have, I think, led into my question. How is your portfolio positioned regarding a blockade of Taiwan or a seizure of Quemoy and Matsu?
Yeah, it's always a pertinent question, and I think, let's see this on a probabilistic scale, right? It's not 1 or 0. Things can happen, and things might not even happen, right? So that thing you have talked about, that geopolitical risk has always been present, right? I've tried to address this question many times, but you can argue that today it's even more pressing. Fair comment. But I think one thing we do is, once again, Taiwan is not a huge active position in the trust, so we control things we control this risk from a portfolio perspective. And then once again, I mentioned to the lady over there that the companies we invest in are increasingly having facilities, especially the semiconductor companies are having facilities in the US, in parts of Europe, and in different parts of Asia as well. The supply chain has diversified a lot. So that risk we control on a portfolio level and at a company level.
Okay. Final question and a brief one, please. Yeah.
Short question. The United Kingdom has not traditionally been seen as part of Asia. Could you comment on what you're holding in the UK and why?
Right, that's a very keen observation. So that's Rio Tinto. It's a mining company. That's mostly iron ore, some copper as well. But it's an Australian company, but we buy the GDR, which is it's listed in the UK. So it's actually Australia. Yeah.
Thank you.
Okay.
Thank you very much. Thank you very much, Isaac. Thank you.